What's going on, everybody? This is Hando Kim. Today we're going to talk about capitalization yield rates for commercial properties. What the heck is it? How do we apply it? Here's a video for it, so make sure you tune in. Let's go.
Nope.
Alright, let's say I sold you this pen right now, okay? And I told you, buying this pen, you'll receive $1 million from me every year. Then what would you offer for this pen?
That's the attitude. You can sell anything. Sell me this pen right here. You can sell anything, sell that.
Go ahead. Sell me that pen. Can I finish eating first? I need tonight.
Come on, tell me, have a think about it. What would you offer for this pen? Alright? If you just shouted a number and you're thinking about numbers, you're doing commercial property wrong. You should be asking me more questions. So what kind of questions should you be asking? You should be asking, Hando, how good are you for this $1 million you promised on this particular pen that you're trying to sell me? Well, that is a fantastic question. And that's where the story of capitalization yield rate begins. So here we go. So we've got a commercial property, let's say, and with that commercial property, you're gonna have cash flow coming in, all right? How are you gonna get that cash flow coming in? Well, it's called rent, all right? And who pays the rent? The tenant pays the rent, okay? Well, then it's important to know who the tenant is and what kind of agreements and what kind of contract that they're under to actually be obliged to pay you the rent that they are either paying, or whether an imaginary tenant will come onto a vacant property and is able to pay and how much for. So that's the question that you want to ask. In commercial properties, the security of such rent, the more securities, the lower the capitalization yield rate is going to be. So what is capitalization yield rate? Well, it's basically what your rental amount is in percentage to the value of the property that you pay, the capital value of the property that you pay. So let's say the value of the property was $10 million, and the rent that the tenant within such property was paying $1 million a year. Well, then guess what? You are buying a property at 10% yield rate. So that's what it will be. Sounds pretty good because it yields pretty good, and that's without without calculating how much the property will grow up in value based on market and location factors and things of that nature. That's just basically what's been agreed by the tenant, and that's what you're getting them. Obviously, if you've got a really good tenant with a really long lease that they've signed, and when I say long leases, it could mean, I mean, how long is a piece of string? But I've seen long leases that go up to almost 30 years in the initial term. So that's pretty long. A short-term lease is basically maybe a year or two. But depending on the business, 2-year lease might be considered pretty long. Okay, and depending on the business, 5 years might be considered pretty short as well. And it depends on how big they run their operations as well. But let's say you've got for example, a really good company. Let's think of a good company. Let's say you've got a supermarket. You can go there and buy stuff. A lot of people know the brand. People can go in and buy stuff. And it's a multinational company, and they've got a really long lease to it. Well, guess what? Then you're going to have yields that are going to be under 5%. Whereas then, if you've got, like, let's say a boutique store, no offense to people who run boutique stores, but let's say it was a fashion and it's kind of, it's dated and it's not really turning in the numbers that it probably should, or because of the market factors and the increase in the e-commerce that's out there, it's not particularly doing so well. It's got a really short lease left over. Then the yield rate on that will be pretty high, sort of 9 to 10% sort of ranges. So it really depends, and also the location and how easy it is to find tenants and replace tenants. They all play a factor in determining this yield rate. So obviously, the lower the yield rate, the more you're going to pay for your capital value for the purchase of such property that's already tenanted. The implications of this and the value add opportunities because of the understanding around capitalization yield rate is quite substantial. So I will be making some more videos around that as the days come along. But that's what capitalization yield rate means. I've seen buildings that are tenanted to the police, for example, that they need their headquarters, they need to lease out that space. Well, then you can probably sell that asset at a pretty low capitalization rate. And the length of the lease also has an impact on the capitalization yield rate, and that usually it compresses it. So it reduces the capitalization yield rate. Therefore, by having a long lease, you can have a much higher capital. So that's how you can actually build value into your business. So you can actually find better tenants who will be staying there for a longer, will be committing to that space for a longer period of time. Therefore, turning a capital increase just for that, instantly. For example, fast food chains, KFCs, McDonald's, those guys, if they come and tenant your property, like they lease out your property, well, then I've seen KFC sell as expensive as 2.5% yield rate, which is pretty crazy. Now, where are the higher yields and where do they come from? Well, people like high yields, right? But the problem is with higher yields come with great risks. But those risks, depending on your specialty and depending on what you're used to doing and your resources and the people that you're connected to, might not be a particular risk. So those are the value add opportunities that you might be going for as well. In that, Let's say you found a property with a pretty shaky tenant, or maybe a non-existent tenant, and therefore the yield rate has increased to about the 9 and the double digits, right? Then you buy that property, and then you go and find a tenant or make some improvements on it so that you can accommodate a tenant, bring them in, or you might already know them and you might tee them up before you go and find the real estate that they would be suited to. Go and buy that in, and then put them in there, and therefore you have a running cash flow with a longer commitment than, or non-existent or really short commitment. From there, you can then build instant equity to your property, and then boom, you should be able to sell that property at a lower capitalization yield rate than what you have initially purchased the property for. So that's what capitalization yield rate means. With more risk comes at a higher capitalization yield rate. Now, what are some of the assets out there selling for? Okay, well, in the market that I'm in right now, I'm seeing industrial estates that have industrial tenants, where we see them sort of sell around that 6 to 7% mark. A lot of retail is selling around that 7 and slightly above sort of percentage mark as well. With offices, you're wanting to go a bit higher than that. I think the effect of COVID made a lot of people want to go work from home, so the pool of tenants out there looking for office properties have somewhat dried up. So in that sense, then the capitalization yield rate for offices have gone up a little bit as well. It also depends on the location. If you're going sort of rural, regional, those kind of locations, or then you're going to have higher yield rates as well, so that it takes into account the risk factors of finding an alternative tenant should they move out as well. Another thing to sort of bear in mind is the tenancy mix. Whether the building or the property that you're buying has a lot of tenancies, well, that's a good thing and a bad thing at the same time, but it's probably better than having a shaky tenant that occupies a whole space in just one. Let's say there's a huge warehouse and you've only got the one tenant in there, well then they leave, well who's gonna fill that back up again? And you've gone from hundreds of thousands of dollars rent per year to actually no income whatsoever. So that could be a danger factor as well. So you will see different yields coming at that point. But the good news for you is that whatever these yields are, between 6 and or even 5% all the way to 8 or 9%, the fact of the matter is that you will be borrowing at a much lower rate than that. If you have an LVR, which is loan to value ratio, which means the amount of money that you put down into buying a property, let's say that goes around about the 30 to a 50% mark, you should be getting pretty good interest rates just from your brokers and things like that, so that you can actually still be positively geared in owning all of these properties. And the good thing about owning these properties at positive gear is that yes, you have some income coming in and that's all great, but it gives you the ability to hold these assets for a long period of time when a better day will come along and this side becomes a development potential or anything like that. That is if you don't buy it as a strata. But these are ways that you can actually then capitalize a lot more later down the track whilst enjoying the cash flow that comes from it. Not to mention the cash flow from these properties are a lot better than your residential counterparts, and you are able to then obviously roll out a portfolio so that you can then build wealth around commercial property. So that's my little explanation about the capitalization yield rates. I'm sure I'll be making more videos around this so you guys can actually have a much more comprehensive understanding around it. Should you have any questions, please leave them down below. Make sure you like, subscribe and follow. Do whatever you need to do to see this face over and over again. I hope you want to do that. I want you to do that. So, and I will seek to make better and better videos as the days, the years and the decades come along. All right, take care. We'll speak soon.